Today, we're tackling something huge, something that affects almost everyone.
The car market.
Exactly. The incredibly turbulent state of the car market. For years, we kind of understood how cars worked. They lost value, predictably.
Right, that basic rhythm.
But that's fundamentally shifted. It's
Yeah.
it's not just you thinking things feel weird. They have changed
Yeah.
dramatically.
Yeah, they really have.
Okay, let's unpack this.
Absolutely. And the data we're looking at today really shows just how, well, astonishing these changes are.
Because, whether you're trying to buy or sell or just handle your payments,
Yeah,
it's a completely different world out there than just a few years back.
totally different.
So what is really going on behind the headlines? Why have cars suddenly become, well, some are calling them America's #1 wealth killer?
Hmm.
Why did used car prices just shoot up like that? It defied all logic. And now, why are some crashing down?
Yeah, the volatility is incredible.
And maybe most importantly for everyone listening,
Yeah.
what's the data telling us is likely to happen next, say over the next year? And how can you navigate all this?
Well, today our insights are coming mainly from a detailed analysis called It's Over. The car market bubble just popped.
Okay.
It was originally on the Graham Stephan YouTube channel, and it pulls together data from, various financial reports, industry analyses.
Gotcha.
So we'll dig into those questions, pull out the key insights from that material.
Great. Let's start with the before times, right?
Yeah.
The old normal.
Okay.
For decades, you bought a new car, you drove it off a lot, bam, instant value drop.
Right, that immediate hit, maybe 9, 10%, sometimes up to 18.
Yeah, something like that. And then year after year, another 10, 20% gone.
Standard depreciation. After 5 years, maybe it's worth 40% of what you paid.
Of just how it worked. The
Yeah.
playbook.
Yeah.
Until recently.
Indeed. The last few years just completely shredded that playbook.
Yeah.
It was this unprecedented shift, really driven by a perfect storm.
What were the main ingredients in that storm?
Well, first, a big shortage in auto manufacturing. You remember the chip shortage?
Oh, yeah. Couldn't get anything.
That was huge.
Yeah.
Limited supply of parts overall. Then you had record low interest rates. Money was super cheap to borrow.
Right.
And on top of that, a massive surge in demand. People wanted cars, maybe avoiding public transport, stimulus money.
So a few cars being made, cheap money, everyone wants one.
Exactly. And that combination just sent used car prices, well, defying gravity.
It was genuinely astonishing. I remember seeing reports back in, 2021?
Mm-hmm.
Used car prices were like 40% higher than the year before.
40%? It's staggering.
People were literally, buying a car, driving it for a bit, sometimes years.
And selling it for a profit.
Yeah, like driving for free or even making money. It sounds completely nuts.
It does, but it was happening.
And it wasn't just used cars, new cars too, right?
Yeah.
People paying over sticker.
Oh, absolutely. Through 2022, that was common. At the peak of the shortage, the average price was nearly 10% above MSRP.
Just to get a car. Any car sometimes.
Pretty much. Pure supply and demand imbalance.
But, other pandemic shortages eventually sorted themselves out. Toilet paper came back. Lumber prices dropped.
Right.
Cars, not so much. Prices never really went back to where they were before, did they?
Not really, no. Even now, new cars are still, on average, about $12,000 more expensive than just a few years ago.
$12,000. Wow.
And think about what that means for affordability. For the typical family now, buying a new car can eat up 70 to 80% of their entire year's income.
70 to 80%. That's huge.
It's double what it was back in 1990. Cars are just outpacing incomes significantly.
So it's not just an expensive purchase anymore.
It's becoming a major financial burden, a real wealth drain. It can stop families from saving, investing, buying a house.
Which is exactly why it gets that label, America's #1 wealth killer.
Precisely. It eats up so much current income and future financial flexibility.
Okay, so prices went crazy.
Yeah.
But how did people actually afford these expensive cars?
Well, that leads us to the financing side. The silent killer, as some call it, auto loan debt.
Okay.
Most people finance cars. We're talking 85% of new car purchases, 55% of used cars, they're bought with debt.
That's a huge majority, especially for new cars.
It is, and here's the kicker. Auto loans don't have the same strict checks as, say, a mortgage.
What do you mean?
With a mortgage, they verify your income, your assets, your credit history really thoroughly, protects everyone.
Right.
Auto loans often much looser. Lenders can, and apparently often do, give out loans without fully checking if the borrower can actually afford to pay it back.
That sounds risky.
It creates this potential time bomb of debt for a lot of people.
There was that Jalopnik report, wasn't there? Late 2021?
Yeah, that was eye-opening. They called the auto loan landscape, I think the phrase was, a true wild, wild west and a poorly regulated wasteland.
Wow. Strong words.
Their investigation found borrowers across all credit scores, good, bad, in between were getting loans with crazy APRs, anywhere from 0% up to over 25%.
25%. Good grief.
And sometimes people with good credit were getting pushed into high-interest loans, maybe double the average, just because they were desperate for a car and maybe didn't shop around.
That feels predatory.
It highlights a market where the rules were just very, very loose.
And Consumer Reports found similar things,
They
right?
did. Their findings were also pretty alarming. They estimated that maybe 25 to 50% of auto loans were given to people who, well, might not have realistically been able to afford them.
A quarter to half? That's massive.
And here's why. They found lenders rarely actually verified income and employment.
They didn't check if people had jobs or could make the payments.
In the loans they looked at, those checks happened only about 4% of the time.
4%.
Just 4%. So very little due diligence, putting a huge, often unsustainable burden on the borrower.
And we're seeing the fallout from that now, aren't we?
Absolutely. The consequences are becoming clear. Right now, 5% of all auto loans in the U.S. are seriously delinquent over 90 days late.
5%. That's a lot of people struggling.
It is. And subprime loans. Those given to borrowers with weaker credit, record high delinquency rates.
Oof.
Plus, get this, 39% of all car buyers are underwater.
Meaning they owe more than the car's actually worth?
Exactly. Almost 4 out of 10 buyers. It's not just a few bad situations. It feels systemic. It traps people in negative equity cycles.
Which goes right back to that wealth killer idea. It's a liability, not an asset.
And what's fascinating here, something highlighted in an Iowa law review,
Yeah.
is that over the last decade or so, car dealerships have started making more profit from financing the cars than from selling the cars themselves.
Wait, really? More from the loan than the car.
That's what the analysis suggests, which means they have a direct financial incentive for you to take out the biggest loan possible.
Wow. That completely changes their motivation, doesn't it?
It really does. It's not just about moving metal, it's about maximizing that loan value.
So how big has this auto debt bubble actually gotten?
It's huge. U.S. auto loan balances hit $1.64 trillion.
Trillion.
With a T. It's the second biggest debt category for consumers, right after mortgages.
Bigger than credit cards. Bigger than student loans.
Bigger than both of those, yeah. And it's grown incredibly fast, up 70% in the last decade alone.
7% increase.
Yeah.
That's staggering.
And to make these massive loans seem affordable month to month.
They stretch out the terms, right?
Exactly. Instead of maybe a $30,000 loan over 4 years, which was more common pre-pandemic.
Yeah.
Now you see people taking out $50,000 loans over 7, even 8 years, just to keep that monthly payment looking manageable.
But over 8 years, the total interest paid must be enormous.
Massive. You end up paying way more in interest. You build equity much slower, if at all. You're just deeper in debt for longer.
Okay, so the financial side is pretty concerning. What about the actual cars? The inventory on the lots?
Right, the physical supply. We often measure that using days supply.
How many days it would take to sell everything currently available?
Exactly. At the worst of the shortage, many brands were under 30 days. Some popular cars sold instantly.
I remember empty dealership lots.
Yeah. But today, the overall market average is back around 70 days.
Which is considered normal, balanced.
Pretty much, yeah. It suggests the big supply crunch is largely over for the market as a whole.
But as a whole is key, right? It's not the same for every brand.
Definitely not. There are big variations. You look at, say, Dodge, they're sitting on about 111 days of supply right now. Ford's at 99, Lincoln's way up at 127.
So lots of unsold cars for them, which means...
Potential discounts for buyers, room to negotiate.
Okay, but other brands.
Still really tight. Toyota, Honda, Subaru, they're still seeing very high demand. Some of their popular models are under 40 days supply.
So less wiggle room on price for those.
Much less. The prices are holding firm.
And this split must be affecting used car prices too. Are we seeing winners and losers there?
We are, and some of the results are a bit surprising.
Oh.
The biggest year-over-year increase in used prices recently, the BMW 4 Series, up nearly 20%.
A BMW, why?
The theory is, limited supply of new luxury cars pushed buyers into the used market, keeping demand high for certain models. We saw similar things with the Infiniti QX60 up over 16% and the Porsche 718 up almost 16%.
Interesting. So luxury held value or even gained? What about the other end? Biggest decreases.
Ah, that would be Tesla.
Really? EV prices are dropping.
Significantly, Tesla prices fell double digits over the last year. One analysis even said they depreciated something like 70 times faster than a Chevy.
70 times. Why such a big drop for Tesla?
Probably a few things hitting at once. Elon Musk's public image has become more, let's say, polarizing for some buyers.
Okay.
Plus, EV technology is changing so fast, some people might be waiting for the next big thing instead of buying now.
Makes sense. Tech obsolescence.
And also, maybe a lot of the early adopters, the people who really wanted an EV early on, they've already bought one, so that initial surge of demand has cooled a bit.
So bad news if you own a Tesla, maybe, but
Potentially good news if you're looking to buy a used EV. Could be some decent deals out there now compared to a year or two ago.
okay, so we have inventory balancing out, winners and losers in used prices. Feels like things might be stabilizing.
You'd think so, but there is another curveball potentially coming.
Oh no, what now?
Tariffs.
Tariffs.
Cars.
Yep. Automakers are apparently bracing for a potential 25% tariff on imported vehicles and parts.
25%, that's huge. That could completely mess things up again, couldn't it?
It really could. Analysts are estimating these tariffs might add around $3,000 to the cost of a U.S.-built car
Wait, even cars built in the U.S.? Why?
because almost no car is 100% domestic anymore. Even if it's assembled here, manufacturers import parts, materials, components from all over the world.
Yeah.
Mexico, Canada, Asia, Europe,
Ah, right. The global supply chain, so tariffs on parts hit everyone.
pretty much. And for vehicles actually assembled outside the U.S., like in Mexico or Canada, the estimated hit is even bigger, maybe a whopping $6,000 increase per vehicle.
$6,000 just
Yeah.
from tariffs. That's the estimate. These are serious numbers.
So cars built here get more expensive, cars imported get way more expensive.
And there are other potential ripple effects, too. There's talk that if tariffs make lower-priced cars unprofitable, automakers might just start making them.
Seriously. They'd just cut affordable models.
It's a possibility being discussed. And if certain imported parts become too expensive or hard to source, we could see production delays again.
So just as the market starts to cool off, tariffs could heat it right back up.
Ironically, yes, it could reverse the trend. One estimate suggested tariffs could add maybe $2,000 back onto the average new car price, wiping out any recent cooling.
Okay, this is a lot to process. So looking ahead, say the next year, what's the realistic outlook for someone needing a car?
Well, putting the tariff uncertainty aside for a moment, most experts think used car prices will probably continue a gradual downtrend.
Because of those higher inventories and maybe more defaults, putting cars back on the market?
Exactly. And some forecasts suggest new car prices might dip a few percent too, as competition returns and inventory builds.
Okay, a slight softening maybe.
But, and it's a big but, if those tariffs stick around for a while,
Up bets are off.
they could easily erase those small decreases or even make new cars more expensive again.
And if new cars get pricier?
That pushes more people back towards used cars, especially the more affordable ones.
Yeah.
We're already seeing that pressure in the under $20,000 segment. People are having to look at older, higher mileage cars because new and slightly used are just out of reach.
So it's complicated. What's the actionable advice then, if you have to buy a car soon?
Okay, based on this deep dive, a few key things. First, take your time.
Don't get rushed.
Right. Don't let a salesperson pressure you. Don't fall for limited time deals without thinking. Second, negotiate, especially on those models with high day supply we talked about.
Like the Dodges and Lincolns right now.
Exactly. There's likely room to haggle there. And third, maybe the most critical piece. Yes, shop the loan around. Do not just accept the financing the dealership offers you first.
Because they might be making more profit on that than the car.
Precisely. Check with your bank. Check with local credit unions. They often have the best rates.
Yeah.
Get pre-approved before you even walk into the dealership.
So you know exactly what you can afford and what a good rate looks like.
Yes. Doing that homework can save you thousands over the life of the loan. It's absolutely worth the effort right now.
Okay, shop the loan.
Yeah.
What about rules for how much car you could actually afford?
The classic rule of thumb is the 24-10 rule. Have you heard of that?
Remind me.
It's put down at least 20% as a down payment, finance, for no more than 4 years, and spend no more than 10% of your gross monthly income on all your transportation costs combined.
So payment, insurance, gas, everything. under 10% of your income.
That's the guideline for staying financially healthy with a car purchase.
And how does that compare to what people are actually doing?
Well, the reality is quite different. The average down payment now is under 12%.
Not 20,
No. The average loan term is 72 months. That's 6 years.
not 4.
Right. And people keep their cars, on average, for about 71.4 months.
So they're basically trading it in just because the 6-year loan is ending. Or maybe even before.
Often before, yeah. Which means they frequently roll negative equity, the amount they still owe, into the next loan.
Starting the cycle all over again, but even further behind.
Exactly. That trend is a recipe for staying trapped in car debt. It really needs to stop for financial well-being.
So the ideal path for most people is,
Honestly, stick with a good, reliable used car you can genuinely afford. Pay cash if possible, or pay it off super quickly.
and then drive it for as long as possible.
Drive it till the wheels fall off, basically. That's how you break free from the car payment cycle and actually build wealth elsewhere.
And if someone's struggling right now with payments on an expensive car they bought during the peak,
Now, might still be a relatively decent time to sell, especially if it's one of those EVs that have dropped in value.
get out from under it.
Yeah, sell it, take the hit if you have to, and move into something much more affordable. It could relieve a lot of financial stress long term.
Okay. So, wrapping this up, it's clear the car market has been on a wild ride and is still transforming.
Absolutely. Unique supply issues, demand shocks, those lending practices, and now these potential tariffs. It's a complex mix.
So being informed, being strategic, understanding the financing, it's more crucial than ever. Hopefully this deep dive gives everyone a better handle on their own situation.
And maybe something to think about beyond just your own car. If we connect this to the bigger picture,
Yeah.
how might all these shifts, cars as wealth killers, the debt issues, tariffs, the move towards EVs, how might this all influence wider consumer spending?
Hmm.
Or even shape the future of how we get around our transportation infrastructure?
That's a great point. How does this ripple outwards? Definitely something to keep an eye on and think about. A lot more going on than just the price tag on the windscreen.
For sure.
Well, thank you for joining us on this deep dive. We encourage you to keep thinking about these trends and how they play out.
Thanks for listening.